Hey guys, welcome back to the channel. Today I wanted to go over seasonality, more specifically what happens during December, to see if we can get some sort of indication of when to buy and when to sell. So for this tutorial, I'm just going to use indices, but you can do this with stocks as well. So this is the output table, and again, I'm only using December. So I had to pass in a combinations table of days of when to buy and when to sell, indicated by the first trading day to the very last trading day of the month. And if we were to sum the perfect profit, meaning if we were to buy and sell at the highest point, this would be the number of points we have gained through the years. Inversely, if we were to buy on the first day and held to the lowest point, and we add all those points through the years, this would be the sum of the points we would have lost. And if we were to buy on the first day until the 21st day and sold at the open, we would have gained 34 points, almost 35 points. But this is the sum of all the years together, and I believe this goes back to 1993. I'm using the SPY. So again, buying at the open and then selling at the open on the 21st day, and then buying at the open on the first day and then selling it at the close, we would have gained 32, almost 33 points. And then the last two columns is what I really want to focus on. These are the winning percentages. So buying at the open and selling at the open would be this column, and then buying at the open and then selling at the close would be the last column. So if we sort these, we see that the best combination for an open to open would be buying on the 15th trading day and then selling it on the 19th at the open, which has an 81% win rate. And also this buying on the 16th trading day and then selling it at the open on the 18th trading day has the same win rate. If you want to trade the close, we see that we also have an 81% win rate for this combination and the following combination. And then we can verify the trades, because this function that I'm going to show you will generate a CSV file with all the years. So if we take a look at that spreadsheet, here I have filtered out the 16th and the 18th, and then we could see all the trades by year. So in 1993, we would have bought at this price. The best possible price between the 16th and the 18th trading day was $47, and the minimum price was $46.50. The opening price on the 18th day was $46.75, and the closing price on the 18th day was $47. So these last four columns give you a summary of each year. So we would have bought it and then sold it at the very best price, we would have gained 41 cents. If we would have sold it at the low, we would have lost 9 cents. But if we would have held it through the 18th trading day and sold it at the open on the 18th, we would have gained 16 cents. And then if we would have held until the close on the 18th trading day, we would have gained 41 cents. So again, the table in R is just a summary of this. So if we take a look at the sum of bought to best, we get 48.68, which is this number here. Bought to worst, we have a sum of negative 22.66, which is this number here. The sum of buying the open and then selling at the open is 29.51, which is this number here. And then buying at the open and then selling at the close on the 18th trading day yields 28.52, which is what we have here. And since 1993, I see 1, 2, 3, 4, 5 losses. So that explains the 81% win rate. And if we drill this down further, we could take a look at 2019 and see that we bought at 321.59. So if we go to Yahoo Finance, we see 321.59, which is the 16th trading day. So if you count from December 2nd to December 23rd, that should have been 16 trading days. And then the strategy goes that we have to sell it on the 18th trading day, which would be December 26th. So if we take a look at our results, we see that the maximum price was $322.95, which happened on December 26th, $322.95. The minimum price was $320.90. So here we have $320.90, which happened on the following day. And then if we would have closed on the 18th trading day, the opening price should have been $321.65, which it is, and the closing price is $322.94. This is the adjusted close. So again, buying at the open at $321.59 and selling it at the best price, which was $322.95, we would have yielded $1.36 per share. Selling it at the lowest would have yielded negative 69 cents per share. And then buying it at the open and then selling it at the open on the 18th trading day, so $321.59, and we sold it on the 26th at $321.65, would have gained 6 cents per share. And if we would have held it to the close, we would have gained $1.35. So depending on what you want to do, whether you want to sell it at the open or selling it at the close, you have the option to view those results. So hopefully that was a clear explanation on what's happening here. And again, this spreadsheet here will generate from the script I'll go over briefly. along with the table called res. So if we take a look at our code, I'm only going to require data table and quant mod, and I have one function called find best day. So I'm passing in the data. I'm going to find all the years in the data, and then I'm going to pass in those years to do the calculations. So after I pass in the years, I will then find combinations of trading days, and then we'll do the calculations to find the number of points and our win rate. I'm going to combine that into a data frame, assign it some column names, and then I'll use row bind to output the results. So within the function, I will write the results to a CSV file called seasonal dump, which is the spreadsheet I showed you earlier, and that will be in your working directory. And then I'm going to combine by year to get this res data frame, which has the summary and the win rates. So we minimize that function. We are left with inputting the ticker we want, getting the data from Yahoo Finance, and note I want December only, which is month 11, because this is indexed at 0, so 0 to 11 should be 12 months, and I'm passing that into our function called find best day. So if you want to test what happens in January, you would put 0, and so on for the rest of the months that you want to test, but we'll leave it at 11. So all you really have to do is run this function, assign a ticker that you want to test for seasonality, change the month if you want something other than December, and then pass that into our find the best day. So here I'll assign it to something else. We'll do the Dow Jones. We'll get the data. We want December only, and then we're going to pass that into our function. This may take a few seconds, and after that's done running, we'll take a look at res, and then I'll sort by the opening price. So here we have a slightly better win rate, which is a tie with other trading days. But what you can do is drill this down even further by opening up that spreadsheet in your working directory called seasonal dump, and then taking a look at the trades done each year. Also, please note this is not trading advice. I'm just showing you how you can test for seasonality. So even though these are pretty good win rates, you're not guaranteed to win this year or the following years. So please keep that in mind. So this concludes this video, guys. I hope you enjoyed this video, and I hope this information was somewhat useful. Feel free to message me if you have any questions. Please subscribe to the channel if you haven't done so already, and please give this video a thumbs up if you enjoyed the material. Thank you for watching, and I'll see you guys in the next video.